All right. Good morning, everybody. This is Brian Lysing with Financial Brokerage, and this is the life insurance-based LTC Planning Path webinar. Your lines have been muted to cut down on background noise, but we'll have time for questions at the conclusion of the webinar. Feel free to type any questions at any time, and I'll answer as many as possible at the end. If you're not already familiar with Financial Brokerage, we're an insurance marketing organization supporting advisors and agents nationwide in the areas of life insurance, annuities, LTC, disability, and Medicare supplements. I specialize in life insurance and have been in the industry for over 2 decades now. Now, today's webinar stems from questions that I receive from advisors just like you just about every week. And because of that, I thought it made a lot of sense just to put the answers together into a webinar that everybody can access. Today we're going to talk about what happens when your client comes to you, or you've already had a discussion and realize that they need some sort of long-term care protection, and they don't necessarily want a traditional long-term care policy. We've already made that determination. For some people, a traditional LTC policy is exactly what they want and what they need, and that's fine. But we're working off of the assumption that that's not going to work in their particular situations. So we know they want a life insurance-based product already to protect their assets from the high cost of long-term care. They've already agreed they need to do something about it, but we don't know how much coverage they need, how long they might need the coverage, what options do they have to pay for it, and what type of product best fits with their situation. These are conversations I have every week with people going through all these things. Someone calls up and wants a quote, and I start in with exactly these same questions. So we're going to try to give you some resources that you can use with your clients to come a little bit better prepared and to help them craft a solution that's going to fit with their situation. So I've distilled this down into 4 main steps, and really I've just borrowed resources from our partner insurance companies that we work with here at Financial Brokerage. But in step 1, we're going to cover how you can help clients determine the costs in their area, both today and in the future when they're likely to need care. How long should we account for? How long do people generally need care? We're going to go over some funding sources. Some will be obvious. Some will be sources that maybe you weren't aware that your clients could tap into. And in the 4th step, we're going to review some of the main life insurance-based product types that are available there. We're not going to get into company specifics, but we will give you a broad overview of the types of products that people typically use. Each client you come across may be attracted to a completely different one, and that's fine. Just about every insurance company has something available today anymore. So let's get into this here with step 1. How do you determine the cost for care? I mean, some people know they have had a close relative that has required care recently, and they have a good idea in their area what those costs really are. But for some people, they don't know, and they certainly don't know once you apply an inflation factor to the current number, what those costs might be in 20 or 30 years when they think they might need care. So a couple of our partner companies have got some online calculators. There are no passwords required to use these, which is fantastic. So I'm going to show you what a couple of them look like here. I really like Mutual of Omaha's calculator, and we'll see if we can get this to work on the screen. And sure enough, it is. So once we get to their website, I think I have this preloaded. You can plug in the state that you're in and look at the average cost of care. This was put together in 2019. And that's fine. If you want to know what it is in 2020, just say that we want to know the cost of care in 1 year. and it defaults to 3% inflation. But since our office is here in Omaha, Nebraska, we're using Nebraska. And let's say we're dealing with a client who thinks they might need care in 20 years from now. I'm going to switch this over to the costs per year. But home health care, about 60 grand a year. A actual nursing home, private room, we're now approaching 100 grand a year. But look at these numbers in 20 years. 100 grand a year isn't going to cover it. We would likely need 176 grand. If we look at home health care, 60 grand won't cut it in 20 years. We need about 110. Again, you can play around with these numbers. You can look at what the costs would be in, let's say, 30 years. And we're going to see that those numbers are going to go up significantly. You can put in a different state. Let's go somewhere farther away from where we are and look at Massachusetts. So the number is going to be a little different depending on where you are. So you can use this calculator as a starting point to help your clients figure out what the cost of care might be in their area. You can print it off. Again, no passwords required. Lincoln Financial also has a calculator that you can get to with no passwords required. And this one's a little bit different. You actually have to put in the costs over here, but it also allows you to plug in funds that the client might have available. You can choose your inflation rate, years of care, and then it's going to give you a printout displaying what that total financial obligation is going to be for your client. So a couple of calculators that you can utilize to determine both the current and the future costs of care for your clients. Now, step 2, we've already determined what it's going to cost our clients per year, but now we need to ask, how many years of care should we plan for? You've probably heard about the average length of care being 3 years. Now, keep in mind that they get to that average by including end-stage cancer patients who might need care for a month or two, along with Alzheimer's patients who might need it for a decade or more. So be sure and ask your clients about their family history, what happened with their grandparents or even their parents who needed care. How long did they need it? Is there longevity in their family? That's going to play a big part in what they are comfortable with from a coverage standpoint. But to get beyond that, we can also use some actual statistics to give us a more precise picture. And I pulled this chart from one of Lincoln Financial's guides on their MoneyGuard product, and they in turn pulled it from some statistics from the LTCI. They're using numbers from 2016, but I can't imagine that they are tremendously different in the year 2020. So again, this is a question we get quite a bit. How long is the average length of care? What if somebody had Alzheimer's and we only need to account for 3 years or 4 years or maybe 2 years, that sort of thing? Well, here we can use some actual numbers to help determine that. So the way this chart works, I'm going to point you to a column almost all the way to the right, so we can understand what this chart is telling us. And let's look at the ages 85 to 89 column. And so that number beneath that, 80%, that tells us that if a person goes on claim between the ages of 80 and 89 for long-term care, after 3 months, 80% of those people are still on claim. All right, what happened to the other 20%? Well, either they got better or they passed away. And there's, I would imagine, a much greater chance that they passed away because most folks will not necessarily get better when they go on claim for LTC. Now, look at what happens after 12 months. 54% of those people are still on claim. I would probably assume that the other 46% have passed away. So half of your clients that go on claim aren't going to need it for more than 12 months. Well, what happens after 24 months? And these numbers are actually consistent among all the age ranges there. About 35% of the people are still on claim after 2 years. I mean, 65% of them are not on claim anymore. Let's look at 3 years. Almost 22% are on claim, or we could maybe round it to 1/5, right? 1/5 of your clients will still be on claim after 3 years. The other 4/5 or 80% will have passed away. And if you get down to 4 years or 48 months, only 12% of the claimants are still on claim. Now we're looking at almost a 90-10% split, right? Where after 4 years, 90% of those people are no longer on claim. So if you want to use statistics to help determine how long you need to account for, I think this gives you a pretty good idea. Maybe your client needs a lifetime benefit, and that's great if they can afford it. But that's not always the reality of the situation. So you can use this to help your clients determine how long they might need it statistically. All right, so before we move on to looking at some of the funding sources, I want to look at another way to estimate how long your clients might need care. I call this step 2.5 because it's sort of an addition to the first two that we looked at. But this is sort of a quick way to calculate, and much like doing a life insurance needs analysis, you could probably find 100 calculators out there. They're all slightly different, and when you plug in the numbers, you're going to arrive at a figure that is going to be very close among all those 100 calculators. And I think you could do the same thing here, right? You could look at all those steps we already reviewed, come up with a number, or you could use this easy estimation method, and I think you're going to be pretty close. So I stole this quick calculator from our resident long-term care expert here at Financial Brokerage, Leonard Berthelsen. And by the way, Leonard would be happy to help you with any traditional long-term care quotes, questions, along with Medicare supplements and disability. But this is a great idea that he had, so I thought I would include it in here. And so the rule of thumb is to simply add the costs for 1 year each of home health care, assisted living, and a nursing home in your area. Now, chances are your clients will not need those services for 1 year each. That's fine. They're likely to need home health care for much, much longer and a much shorter time period for a nursing home. But this helps make for a real easy calculation. And on the screen, you can see the numbers. I plugged in the numbers for Nebraska here in the year 2020, and the total pool of money would be just over $200,000. If we did the same thing with those other calculators, I think we'd be pretty close. So that gives you some idea of another estimation method you might use with your clients. So now that we know what our client's expense is likely to be, we need to help our clients determine how they plan to fund this obligation. So we're going to look at a couple of self-funding options, as well as a few funding options that actually include insurance. And I'm going to start off, just by using the client's own assets and posing the question, well, what if they self-insure? I mean, that's an excuse we get a lot of times from clients that they don't want to come to grips with the reality of buying a policy because then they automatically think that they're going to use it or need it just because they have a policy, and it's completely irrational, but that's what people tell themselves. And they say, I'm just going to use my own money. I'll self-insure. Okay, fine. Let's take them down that path and show them what that really means to self-insure. And for some of your clients, fine. This could be their plan, right? But if that's the case, wouldn't it be nice to have it down on paper so that their heirs, their family members, can see exactly what their wishes are as far as which assets they'd like to liquidate first? So we'll just force them to put that down on paper, and you can certainly use this with any of your your clients when you're doing going through a retirement planning session with them, or looking at long-term care planning as well. Uh, Simply, you just write down the costs of care in your area that we pulled from the other calculators earlier, and then just add those numbers together. And then there's a spot on the sheet to write down the client's various accounts that they could pull from to fund that obligation. And when your clients start writing this information down, then they might start thinking twice about actually using those accounts. Maybe they had that money earmarked for some other purpose, and now all of a sudden, just by the act of writing it down, they realize, oh no, that money can't go to the grandkids or the kids or the second home. I already have it accounted for the cost of care. So you're going to get them thinking about perhaps doing something different. But this also protects you as an advisor. That way, the client's family can't come to you later and say, well, why didn't you bring up long-term care with mom or dad? You're supposed to help them and protect their assets, and you didn't do it. Well, you can pull this out and say, well, we did bring it up, and this is your mother or father's plan. This is what they wanted to do. They signed right here. So you have that to protect yourself as well. But I thought this was a great piece from Lincoln Financial in case your client wants to explore self-funding for care. Now, another way they might self-fund for care would be to just assume that they are going to need to take more money from their retirement plan at a later point in their life. Now, if you've done any retirement income planning with your clients, this should sound really familiar. Now, the typical retirement spending habits go something like this. When people begin retirement, their spending habits are relatively the same, or maybe a little bit higher than what they were when they were working. They now have time to travel, and they're taking on some home projects that they never had time for when they were working. So early on in retirement, their expenses may actually be a little bit higher. But at some point in time, as they get older, they fix everything, they do the traveling, their spending is going to slow down a little bit more. So you probably want to account to that if you're doing any sort of retirement income planning. But then, at some point in time, there's going to be a medical situation that will arise. The person will be injured, they slip and break or dislocate a hip or a knee, arm, a shoulder, or they are diagnosed with some form of dementia, they get some other dread disease. Well, now all of a sudden they have tremendous medical expenses. They might not even require long-term care at this point in time, but there are going to be some increased medical expenses. And if you're doing some smart planning for them, you want to account for that as they get older. Now, that very well might include the costs of long-term care. So this is actually another way to account for this. If your client is fine with taking a smaller amount of income early in retirement so that they have enough left over to take an increased amount later, you could certainly account for the costs of care this way. I'm guessing, though, once they see the numbers, they're going to want to look at some other alternatives other than just using their own money. So that's where insurance comes into play. And we're going to look at some different ways to fund the various life insurance policies. And one of the things that would be obvious would be using money in savings or current income, and that's fine. But a lot of people don't realize that there are some other funding sources that you could actually use. So one of the great or largest assets people typically have when they retire is the money that's in their 401k or maybe their 403b or their IRA. That's likely to be the largest source of funds available to them. And most people think that that money is just for retirement income. Well, that's its primary intent. But you could actually use those funds to help pay for a life insurance-based long-term care policy. And there's a few ways to do that. One, you could just withdraw the funds every year. You have to pay taxes on them if they're coming from these sources, but then that could be the source that is used to fund the premium for your policy. Now, Another way to arrange that to make it a little bit more automatic would be to take that money and put it into a SPIA, a single premium immediate annuity that has a guaranteed payout. And that payout could be used to fund your life insurance-based long-term care every single year. Now that could get a little cumbersome though, because we're writing a check initially and then we're receiving a check every year so that we can turn right around and write another check. There is some room for error throughout that whole process. So we have one insurance company we work with here at Financial Brokerage that does all of that behind the scenes and make it pretty seamless from the client's point of view. And the chart at the bottom gives you a great example of how that works. They will take the money from the IRA or the 401k and conduct a direct transfer into an annuity. Now, there is no taxable event at this point in time. However, that's qualified money when we take it out that is taxable. They will help your clients mitigate that tax hit by using a span of 20 years to remove that money from the annuity. Now, the client never receives the money. They do receive a 1099 for the taxable amount, but the money goes directly into the life insurance-based product that happens to have a long-term care rider attached to it. So they can make this a very seamless process for your clients. Now, another overlooked funding source that I want to bring to your attention is actually using funds from an HSA, a health savings account. A lot of people have this available through their employer. They used to pay for unreimbursed medical expenses until they hit their deductible. Well, the money in an HSA can also be used to fund a traditional long-term care policy or the long-term care portion of a life insurance contract. Now, you have to be careful here. Not every life insurance contract has a true long-term care rider on it. A lot of them are labeled as chronic illness riders. Now, most of these, from the client's perspective, the way they qualify for claims and in many cases the payout, it's exactly the same. Client will see no difference. However, and the IRS looks at it a little bit differently. So if you want to use the HSA funds, it must be a true LTC rider or one of the hybrid products that definitely have a true LTC rider built into them. The other thing to be aware of, not all insurance companies will separate the life insurance and the LTC premium costs on the illustration or in the policy, so it may be difficult to make that determination, but some come right out and do. I forget who I got this idea from, but it was one of those companies that separates those costs out and does that for clients. You probably also want to check with your client's tax advisor to make sure that they're on board with this strategy as well. But if they have some unused HSA funds when they reach retirement, by all means, they can use it for this purpose, and they don't even have to wait for retirement. They could use the HSA funds for the LTC portion in their working years if they would like as well. So continuing on with the funding options, I've actually mentioned these earlier. Traditional sources your clients could use, current income, whatever's in their checking account, and in some cases a non-qualified lump sum if they have a large amount in savings or maybe a CD. A lot of these hybrid products were originally set up as single pay products with non-qualified money. You could use that. Or some of our other carriers have premium deposit accounts that can certainly accommodate a large lump sum of money that then earns interest and is in turn pulled from to pay the premiums every single year. All right, step 4, and I guess before I get into that, a quick recap. We've already determined what care costs in your client's area, how long the client is likely to need that, and what funding sources they have available to pull from. Now we start looking into what sort of a life insurance-based product should we use, and there's 4 varieties that I'm going to walk through very briefly and from a broad perspective here. very commonly we'll use a guaranteed universal life contract, or this is a no-lapse guarantee UL, meaning that if your client pays the set premium every time on time, they take no loans, no withdrawals, the policy will always remain in force. It does not need to have cash value inside of it to make that happen. A lot of clients like this because the premiums are guaranteed to be level for the life of the entire contract. As long as they don't violate those rules I mentioned, the premium will never, ever change. And oftentimes this represents one of the lowest premiums a client could pay because we have the ability to stretch it out for the client's lifetime. You can run an illustration showing premiums payable through age 120, and that certainly serves to reduce the ongoing annual premium. Another UL variety that is gaining a lot of popularity right now is the protection-focused indexed universal life. And these were created primarily as a response to increased prices on GULs. In fact, some companies, some major ones, no longer even offer a GUL, but they do have a protection-focused IUL. So these don't have the same sort of, in fact, you won't find a lifetime guarantee in one of these products. What they have is a life expectancy guarantee, usually somewhere in the client's upper 80s, early 90s or so. Now that's also a little bit misleading because that assumes 0% interest from day one and maximum policy charges from day one. I don't know of a single insurance company that's ever charged maximum charges from day one, and it's nearly impossible to get 0% long-term on an index product. Reason being, a couple of the carriers have done some research. I've done a past webinar describing this. If you looked at the worst periods in U.S. stock market history, the 30 years surrounding the Great Depression, or even the more recent 10-year period, roughly from 01 to 09, if you had money in an index product with a 9% cap, your rate of return would have been in the neighborhood of 4 to 4.5%. So a 0% return is historically unheard of, right? We're going to have these products in force for 20, 30, 40 years. You want to use the historical worst case scenario, run it at 4 or 4.5%. And if you can get that to guarantee to a particular age, you can feel safe in knowing that it's going to guarantee to that age. Now, we typically run these on a current basis, solving for a specific cash amount at a specific age. But that's going to give your client a little bit lower premium, maybe about 20% lower than the GULs out there. And both the true LTC and chronic illness riders are available on these protection-focused IULs. And incidentally, you don't necessarily have to worry about the policy stretching out that far because the policy costs are, with most companies, waived when the client goes on claim for LTC. So then they don't have to worry about that anymore, and the policy has done its job. Another variety of UL that we could use for a LTC or chronic illness rider would be just a regular index universal life, one that is more accumulation focused. Now, these don't have any guarantees. They're primarily used for retirement income purposes. So we don't typically use these where LTC coverage is our primary focus. But if we happen to be using one for retirement income purposes, you know what, it makes a lot of sense to choose one that already has a chronic illness rider built in, or that has a long-term care rider we could add for very, very little additional cost. Why not give your client a little bit of extra protection? The fourth type of product that we see used would be what a lot of people refer to as the true hybrids. There aren't many out there, but these usually require either a single premium or a short pay scenario, 10 years, 15 years. I don't think anybody does a 20 pay, but I could be wrong there. But generally 10 or 15 years. So the client has to have a little bit more money up front because they have to short pay these. On the flip side, they know when they're going to be done paying the premiums. The premiums are guaranteed again. Don't look at these as a good source for a death benefit. what these products do is minimize the death benefit while maximizing the long-term care amount on the other end. And in fact, on all of these, the total LTC benefit is always going to be greater than the death benefit. So these are very much long-term care focused type products. Now, I mentioned the premiums are going to be a little bit higher. The next slide here, I've got a comparison that gives you an example. And this is a comparison you might want to do with your clients if they're looking at a GUL where they're paying over their entire lifetime, or if they're potentially looking at a short pay true hybrid product. And for this example, I ran numbers on a male age 60, and I assumed a $500,000 LTC benefit. Now for the GUL, that's exactly what the death benefit was as well. I did not write down what the death benefit was for the hybrid, but it doesn't matter because we're concerned about LTC here. So in the example with the GUL, the client pays almost 10 grand a year. With the hybrid, the client's paying almost 15 grand. Now, why might it make more sense to go with the hybrid even though they're paying more? Well, if we look at year 10, this happened to be a 10 pay, by the way. Client is done paying premiums. They've paid in almost $150,000. If they went the GUL route, they would have only paid in just under $100,000. But that client has to keep on paying. So what does it look like in year 15? Well, now the numbers almost equal each other, right? The client would have paid in the same amount roughly into either product. And we're not worrying about the time value of money here. But what happens in year 20? Client has still only paid $150,000 into the hybrid, but now they've paid nearly $200,000 into the GUL. So the client needs to ask themselves, at what point do they see themselves either passing away or going on claim for LTC? And if we extrapolate 20 years down the road, the client is only 80 in this case, or even at year 15 where the numbers even out. The client is only 75. I would imagine the client is not going to need care prior to age 75. It's probably going to be when he is in his 90s or so, in which case it makes much more sense to go with the hybrid. But you know what? Every client's going to be a little bit different depending on their age and their health and the amount, and of course their budget's going to come into play as well. So it makes a lot of sense to crunch these numbers for everybody that you take a look at. All right, well, those are the 4 steps to give you a quick recap here before we get into the questions. First off, we determined the costs in our area. We looked at a calculator from Mutual of Omaha. We also looked at one from Lincoln Financial. Step 2, we looked at the likely length of the need for care using a chart from Lincoln by way of the AALTCI, showing how long claims persist at various ages. After we determined that, we looked at a short form quick calculation, which would work equally as well. We looked at various funding sources that your clients might not be aware of that they could use, and then reviewed the various main product types available. So those are the 4 steps you can take your clients through. Much like a traditional needs analysis, you now have the resources to take them through the same thing when determining how much long-term care they might need in the future. So I want to thank everybody for joining us this morning for this webinar. If you have additional questions and, of course, clients that we could assist you in helping, don't hesitate to reach out to us. We can all be reached here at 800-397-9999, or you could email us as well. And thank you for your time, and we'll open it up for questions here. All right, so if anybody has any questions, you can type them in the box on your lower right. All right. I don't see any questions unless somebody is typing furiously. All right. I'm going to assume I did a very thorough job of explaining everything in that case, and you are all thinking of clients who we can help with all this information. So thank everybody once again for joining us, and hope you have a fantastic rest of your week. Take care.